Hey folks, just had a client that I was talking to and going over this strategy, and I wanted to use their real scenario. So, for the average person, just to show you, how this works for the average person. So they're buying a house. They actually have 10% to put down. They didn't need it. We actually have a bank that is able to provide them with 100% financing, but they are putting 10% down. So they've saved up over a course of 5 or 6 years. They've got their 10% to put down. Credit's not that good. So as you notice here, the interest rate that the bank that they're going to go with is going to give them a 4.25. Now, short story, the bank was trying to put them on an FHA loan, which would have had 1.75% upfront mortgage insurance, 85 basis points a month on monthly mortgage insurance that never goes away, and it would have taken them 30 years to pay it off. So I convinced them, got on the phone with them and the banker that they were working with, loan officer actually, because it was a lender, and explained what they really needed to accomplish. And, over the course of a couple hour conversation, we finally convinced the loan officer, mathematically proven that this is the route that they're going to go. So ended up getting them a home equity line of credit. The husband makes $32,000 a year. The wife makes $27,000 a year. Now, they're pretty lucky. They don't have a whole lot of debt. They only have like 3 credit cards. Their cars are paid off. So they don't have a whole lot of monthly expenses. So what we did is we put in here, this is what their income is net. So that's what they bring in on a monthly basis, is $3,688. And we actually inflated their monthly expenses because I told them that I also wanted to adjust for about $300 to $400 a month for vacation. So just assume that they're spending $300 to $400 a month, and each year, they're going to be able to spend, $4,000 to $5,000 on a nice vacation. So they actually currently don't spend this, and that $2,000 represents groceries, gas, entertainment, eating out, utilities. Obviously, the payment of the home equity line of credit. And again, they've only got about $125 in credit card debt, so they've done really well. So here's the scenario. They're going to take a $118,000 loan on a home equity line of credit at 4.25, and we built in that the interest rate will change. That was one thing that the loan officer tried to convince them to do an FHA loan. Because again, the FHA loan is going to pay him about $3,000 to $4,000. Where on a home equity line of credit, he's probably going to make about $400 to $500. So we understand why he was trying to convince him to do an FHA loan. And, not necessarily his fault. He didn't know the strategy. So it was a good thing I was on the phone to teach him that strategy as well. But the interest rate on home equity lines of credit haven't changed since August of 2008. Prime has been 3.25 since August of 2008. Now, chances are it's going to go up. Reading the news and the economy, I think the Fed is going to increase interest rates at the latter part of this year. So let's just assume that interest rate doesn't just go up, but it goes up every single year that they have this home equity line of credit, which more than likely is just not going to happen. So we set a payoff goal of 120 months, and their current monthly payment, because again, this is their monthly income going into it. They're going to treat it like it's their checking and savings account. It's $3,688, and they're going to pay or put back out of it $2,000 a month in expenses. And look at the bottom line. They're actually going to have this paid off in 82 months, which is a little over 6 years. So this is going to save them over 25 years. And it's more flexible. The wife mentioned to me that, in the near future, they want to get pregnant and she may not want to go back to work. So imagine if they were on a 30-year term with a contract payment, a contract note, that payment doesn't change. And we both know that on a 30-year mortgage, the first 5 to 6 years is front-end loaded in interest. So they're going to pay interest only anyways. So she asked me, she said, well, what's going to happen to this if, in a couple of years we do get pregnant and I don't want to go back to work? Well, they're going to have a lot more flexibility. Let's say, her insurance doesn't cover all of the medical bills. They will actually have that equity to tap into without having to refinance or sell. In worst case scenario, their payment's going to be really low. But obviously, you don't want to make just a minimum payment because you'll be on a treadmill. So I wanted to show another example. Let's do something that's really aggressive. Let's say it's a $350,000 loan. Let's say they also have bad credit and the interest rate is going to go up. But let's say that the husband makes $5,000, wife makes $5,000. So they're making $120,000 a year. Or $10,000 a month. And to be honest with you, to pay for a $350,000 house, you really didn't need to be making that anyways. But after taxes, we're talking about $7,000 a month of income. that's going into the home equity line of credit. And let's say they've got a lot of expenses, $4,000. Again, don't think of a $350,000 mortgage payment as $2,400 because with a home equity line of credit, it's going to be half that. So your actual cash flow increases by doing a home equity line of credit. But again, the $4,000 is eating out, groceries, utilities, credit cards, car loans, you name it. If they paid $7,641, so really let's just call this $7,700. Let's say they actually use their tax refund at the end of the year and pay it back to themselves. Let's say they get an $8,400 tax refund at the end of each year, and they put that just like anybody else. What are they going to do with it? They're going to put it in their checking and savings account. So and you forget the checking and savings account. You put this into your home equity line of credit. So they take their tax refund every year and put it into their home equity line of credit that they can always draw on if they needed to. It would take 118 months, which is 2 months shy of 10 years. So on a $350,000 balance on a home equity line of credit, these folks that are making $10,000 a month gross income or $7,700 a month net and have $4,000 of expenses and the interest rate changes every single year by 0.25%. So meaning that at the end of this period, the interest rate would be 9.25. And again, it hasn't changed off of 3.25 in 8 years. But again, just preparing for the worst, they're actually going to get it paid off in less than 10 years. So it's going to save them over 20 years of mortgage payments. It's amazing.